Good morning and welcome to this Monday, June 21st, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Currently, we do have futures looking up this morning, more so on the Dow, which was beaten down pretty badly last week. A little less bullish on the S&P and even more so on the NASDAQ, less bullish, that is. But that's kind of reversal of what we saw last week, so I'm not too surprised. I will say that Mondays after option expiration Friday tend to be the worst day of the month. But at least early on, looks like we'll get off to a pretty good start. I think when I did my research, Mondays went down 63% of the time, so they went up 37% of the time on the S&P since 1950, the Monday following Friday option expiration, and that compares to 53% of all days going up since 1950. So you can see there statistically there is definitely more odds of seeing a down day on that Monday following option expiration. But at least as we get started, we should get off to a pretty decent start and look for some of those Dow stocks that were beaten down pretty badly last week, maybe to get a little pop. I wouldn't be surprised to see financials make a little bit of move back to the upside. I think that was a little overdone last week, but we'll talk about that. And financial is one of the strongest areas of the market recently. So going into option expiration, I'm not shocked that we did see some of the financials pulling back. Let's go ahead. Before we get into things, let me move over to Earnings Beats for those of you who are new. We do have a free newsletter. Just takes your name, email address, hit that subscribe button. We'd love to have you join our community. It is a completely free, 100%, no credit card required. You can unsubscribe at any time. But we have articles that I publish Mondays, Wednesdays, and Fridays. This morning, I added a company off of our raised guidance chart list that I thought, it's pulled back some. I think it looks pretty interesting to me anyway, based on the fact the company did just recently raise guidance, and now the stock's is actually trading down below where it was. And that was similar to a couple of stocks I gave in the Chart Watchers newsletter over the weekend. So that's a different newsletter over at Stock Charts. But you can get to that just going over to Stock Charts and then looking under articles and scroll back. You should see there were a couple of stocks that I gave from Saturday that I think look pretty good coming off of our raised guidance chart list. But anyhow, if you would like to subscribe, just go to our website at earningsbeats.com. You can subscribe for our free Earnings Beats Digest newsletter. All right, let's move on, take a look at what happened on Friday. So we did close out option expiration for June options, and it was a rough finish for the market. The Dow Jones Industrial Average went down 533 points. The S&P 500 down 55. We talked about this last Tuesday. The directional move that I would have expected going into option expiration week was down. I would have expected the market to fall, which is typical. I mean, that's really nothing new for option expiration week, the last few days, and potentially even the first couple of days after options expire, because a lot of those in the money calls do get exercised, and that puts market makers on the short side as we head into the week following. And I think that's one of the things that pressures the market on that Monday following option expiration. But at least at the open, it looks like we're going to get back some of those points, especially on the Dow. Futures right now on the Dow, I was looking, I think we're up 230 points or so last time I looked. And that was maybe 10 minutes ago. So it looks like we'll get off to a pretty good start. NASDAQ also down almost 1%, but there's what I was talking about on a relative basis. You can see the Dow underperforming, and of the three, the NASDAQ outperformed, even though all three did go down. Mid caps had a really rough finish to the week, as did small caps. A lot of that had to do with energy, which you can see down here was the worst performing sector last week. There's a lot of mid cap, small cap energy companies. And so when energy does poorly, mid caps and small caps have a tendency to underperform as well. But energy performed poorly. You can see utilities breaking down. I was looking for 64 as support. Well, we're there. That's where we closed last week. Kind of surprised with the 10-year treasury yield going back down at the end of the week, that utilities didn't go in the other direction. So going to kind of watch that and see what happens this week. Financials, I think this one was the one that was really overdone last week. Yeah, I think the market's saying what inflation. They see the inflation, but I don't think the market is concerned long-term about inflation. And I think that's kind of right where the Fed is sitting. And so I just think the market is acting as though they believe the Fed. Now, whether or not that turns out to be the case, we're going to find out. But everything I saw reaction wise last week, and of course, you have to be somewhat guarded because it was option expiration week and there's a lot of manipulation. But I would say the primary things that I was looking for coming out of that Fed meeting, I think some of the keys that we are looking for. I mean, when you talk about, first of all, the bond market reaction, should have been, we should have seen a huge spike in the yields. And we did initially, but then they came right back down. So the 10-year treasury yield was back in the 1.45 area. And, that tells me that the market's not that concerned with inflation. That's just one of the things. I mean, also the dollar took off, gold tumbled. I mean, all of these things are factors that suggest to me that the market is not concerned about inflation. But I do think the financials we should expect for a bounce, because I think the economy is going to strengthen. And I do think the Fed is going to have to eventually raise rates. I think if the market is convinced that inflation is not a problem, that is going to be excellent news for the market, stock market, that is, because it's going to keep rates fairly low. The Fed was not looking to raise rates until 2024. Now they've stepped it up to the end of 2023. That's still 2 years away. Low interest rates and solid growth in the economy generally is going to be nirvana for equities. And that's what I expect. And so I do think the yield will turn back up. I don't think we're going back down to those pandemic lows. I would be shocked really to see much more of a drop in the 10-year treasury yield. I think 1.4 is about as low as I would see it going, but maybe I'm wrong. If you see that going below 140, then make sure you're well into some of these growth stocks, because growth stocks, some of them have already taken off. You'll see more of them if yields keep dropping. Staples, rough day. You can see moving down below its 50-day moving average. And of course, materials. This is the group, and I've been warning about this one for a while. I've never really been overly comfortable with materials. I know they've done well, and I kind of take the stance when something's working, stick with it. However, you got to be aware of other factors. And for me, I thought the dollar would bounce at some point. And when the dollar rises, materials struggle on a relative basis. Doesn't mean they can't go higher. I just don't think you're going to see the leadership that we saw in the first half of the year. I'll be very surprised if we see that kind of leadership in materials in the second half, because I think the dollar goes up. That keeps a lid on commodity prices, which in turn caps inflation. But we'll see what happens. The market, though, that was one of the messages I think it sent last week, was materials, that relative strength, I think could be over. And I have another chart I'll show you on that in just a bit. 10-year treasury yield. So this morning, I don't think we had anything out. No, we had nothing out in terms of economic news of substance this morning. So really, I think bond market just trading off of everything we saw last week. And there was a lot, by the way. I mean, we had the PPI came out. It was hot, much hotter than expected. We had the Fed meeting, with tremendous volatility in the bond market and the stock market as a result of that. Retail sales were horrendous. I mean, there was just, and by the way, I think that is just like, I think some of the financials, there's opportunities here. I think also in retail, I think some of those retail stocks that got hit based on that weak retail report, I don't expect to see another one of those very weak retail reports. I would expect this month's to be much stronger. And we've also got earnings coming up in about a month. So I think you're going to start to see more pre-earnings advances. So some of these beaten down retailers, especially some of the leaders that have been beaten down, I think that could be an opportunity there. But looking at the 10-year treasury yield, I mean, this is the daily chart, and this low we saw back on May the 7th went down to about 1.48. Well, we went below that potentially have a double bottom in. We'll see what happens. Here you can see the weakness in the 10-year Treasury yield, the impact it's had on the relative performance of financials. They've been very weak so far in June, but I think maybe too weak. I don't know that this was warranted for it to go down that much. Watch this relative support level here and probably this breakout here. So those two levels, I would be looking for a reversal back to the upside in financials. The other thing you can look at on this 10-year Treasury yield is look at a longer term weekly chart. You know, we had such a huge move back up. Everything throughout this pandemic, I mean, it's been crater and then soar, crater and then soar. I mean, we're seeing that in so many places. And a lot of it too, we're seeing in commodities because of the supply chain disruption. All of a sudden, we wanted all these supplies. You know, all these commodities were in tremendous demand, and there wasn't the supply available. And as a result, we saw, you know, prices really soar. It was just basic economics 101, supply and demand. And I think the demand, which soared, I think the demand will slowly start to subside, and production is going to pick up. So supply is going to be more normal. And I think that's what's going to help to keep inflation in check. But as you look at the 10-year Treasury yield here, that huge move from the bottom, 0.5% here in August to almost 1.8% in May, I think we're going to consolidate that. And you can kind of see over here, see this low, which went down to about 140, and then we made the move up, and then we went down, went back through 140, kind of thinking this 140 on the long term might make sense. And then also, if we go back to that daily chart, this is where we gapped up in March. We had pulled back to about 140. We gapped up, never went back and filled this gap. So I don't know. It just seems like maybe 140 from both the short-term and long-term perspective would be maybe where the 10-year Treasury yield may gravitate to the downside, but I'd be surprised to see it go much lower than that. All right, let's take a look long-term picture on the Dow. So we've got the Dow Jones Industrial Average. This is a weekly chart going back the last 5 years. And I think if we just, you know, if you can just kind of take this period here, February, March, April, May, June, July. I mean, if you just kind of blanked it out, which I guess we could do. Let me see if I can do that here. So if you take like a rectangle here and you get the color white, and then you fill, you're going to fill with white. I mean, if we just kind of do this, you can kind of get rid of that big drop and then big rally. And if you looked at the market and you didn't know anything had happened there, you would really just be looking like, oh, we're just, you know, staying in this bull market. So while it was a tremendous healthcare crisis, it didn't turn out to be the financial crisis that a lot of folks were hyping back in March of last year. There was no Great Depression. You know, everybody thought, okay, that's the end. And now everyone, those in that camp that like to continually call for bear markets are now saying, well, you know, it's the stimulus, it's the Fed, it's the QE, it's this, that. You know, I've been hearing that all my life, how there's always something out there that's going to take the market down. And all I know is it's the best investment of my, well, real estate also a pretty good investment, but the stock market's been a really good long-term investment. And I think from a long-term mindset, I would have absolutely no problem holding on right now. I think the market's going to go higher. From a short-term perspective, you know, anything goes. Short-term is so inefficient, and it scares the bedevil, bejesus, whatever, out of everybody. I mean, you know, you see all these headlines, and oh my gosh, it's going to go down another 10%, another 10%. So you get that first move to the downside, even like last week, having the Dow move down that many points. It's, you know, obviously it's scary. You never want to see your portfolios going down. But I think it's important to keep things in context and bring up this big picture chart, or even the 100-year chart that I go to sometimes. We are in a secular bull market. Secular bull markets will pretty much override any short-term problems that we come up with. And there's one common factor with all secular bear markets, and that is that the monthly PPO will go negative. You never see enough weakness in a cyclical bear market like we saw here and like we saw here. If we get rid of this, let's get rid of that. And if we pull up a monthly, and let's go back, 40 years. If you look here, from this whole period was part of a secular bear market, 2000 to 2012. 2013 is when we finally broke out above the prior highs. This is the Dow. I usually look at the S&P, but 2013 you can see breaking out on the Dow as well. But look at the monthly PPO on the Dow back in 2002, 2003. The reason it goes negative is that we have a long period of going nowhere. Here, we really weren't that high up to begin with. PPO only got up to about 6 on a monthly basis, whereas during secular bull markets, you can see it go into double digits, which we did in 87 before the crash, which we did in late 90s before we finally went into a secular. We haven't even done that yet in this bull market, believe it or not. I mean, right now the monthly's at 7.6. We're not even close to where we normally see peaks in the monthly PPO. That's why, some who are betting against the market, history tells me we could still have a long way to go in this run to the upside. But anyway, just looking at this chart, look at that monthly PPO goes negative. Look at 2018, the trade war right here. Monthly PPO went down to about 5 positive. And even during the pandemic, the monthly PPO went down to about 2, but it stayed positive, never went negative. That's the one thing that when I look technically and I look at momentum indicators, this is the one indicator that I think from a long-term perspective is worth following. Because if you start going into negative territory on the monthly PPO, that is telling you you've probably got some really rough stuff. And you think, well, once you go negative, it's too late. No, it's really not. Here, we went negative in 2001, and we didn't go positive again until after all the selling was done. Here, right when we were breaking down below, what is that, maybe 12,000? That's when the PPO went negative. We went down to under 7,000 on the Dow back in 2009. So you can miss a lot of selling by just simply paying attention to that monthly PPO. And here it never went negative. So long-term never told you to get out. Anyway, I just want to point that out. I think it's always good to take a look at the long-term picture, get that perspective, and then start to look at the daily and the weekly. Because otherwise, when you start with the daily and you don't work off of that long-term reference, that's when I think the emotions take over. And you start seeing the market go down, and you start reading the headline articles, and you're like, oh my gosh, this is the start of Armageddon. It's, anybody, I could be wrong. Everyone out there's got a different opinion. Some will be right, some will be wrong. I could be wrong. I think we're in a long-term cyclical bull market that's going to last another decade. We may have periods like we will have periods like we had in the fourth quarter of 2018. Probably nothing quite as bad as we saw in the pandemic. I mean, to me, that was the equivalent of the 1987 crash, which was also during a secular bull market. So I don't know that we'll see anything like that, but 20% sell-offs from time to time, I think 2 or 3 of those over the next 5 to 10 years, you probably could count on. 1960s, we had a huge bull market. We had 4, maybe 5 recessions during a secular bull market. So keep all that in mind. It's not the end of the world when the market sells off for a period of time. So when I look at the big picture, I like to follow, this is probably my favorite ratio, XLY, XLP. And one of the things I want to make sure is happening is that the XLY discretionary stocks are outperforming staple stocks, because the companies that make up consumer discretionary, they sell us the things that we want. staples companies sell us the things that we need. And when the companies that sell us the things that we want are doing better than the companies that sell us the things we need, that is generally a very good sign of our economy and what the market believes is coming in our economy. So you can see throughout this bull market, we basically go up with a couple of exceptions. 2014 through 2016, remember we had a lot of consolidation. Well, we consolidated in the XLY, XLP before breaking out in 2017. Here, I'm going to just say that this was a one-off. I mean, the pandemic happens, well, it's happened twice now in 100 years, a little over 100 years. So that was a quick move down. Clearly, it was not a good sign, but just as good back to the upside was the rebound and moving back to new highs. So I still see this completely intact. So I think this is a good sign for the market. All right, let's talk a little bit about the financials, because last week, one of the things that was really spooking financials was the yield spread. So I like to look at the 10-year Treasury yields versus the 2-year Treasury yield. The difference in those two yields has a major impact on the bottom line of financial stocks. So if you think that the yield is going to continue to narrow and this is going to continue to drop, then financials are not where you want to be. I mean, if you look down here, you can see what happened to banks. I mean, when this started going down, banks sold off, financials relative to the S&P 500 sold off. And so, yeah, I mean, you're going to have problems when this yield spread is narrowing. I don't believe it's going to continue. I think we're going to eventually turn back to the upside. It may consolidate for a while, but I think eventually it'll turn back up. Maybe you wait for that turn before you get into the financials, or before you maybe add to financials. Maybe you watch this and see if it keeps going down. You just kind of stay away from putting any new money into financials. But I believe if this stabilizes and we start to turn back up, you're going to see a nice rally, not only in the banks, but I think financials in general. Another thing, and this is something we look at all the time. If you're new to earnings beats, you're going to see this quite a bit. This is the ratio between growth stocks and value stocks. What I'm going to tell you is, since March of last year, you can see growth went up, led for a while, value led for a while, growth is coming back. Through it all, the S&P 500 has just gone higher. So this is not having an impact on whether the stock market goes higher. This is simply having an impact on what is leading the market to the upside and what's pausing. So when we came out of the pandemic, the value stocks, the reopening stocks, if you will, those types of companies were not doing well at all. They didn't really participate during this move. Growth stocks took off, and really all the way up until that early September high. Then after that, it was a little bit more trouble. You could see maybe, money rotating over the next few months. And then it was this breakdown in late February below these lows that really, in my opinion, enabled some of the reopening stocks to take off for a few months. And that's what we saw here. That's what led the S&P the upside. We had energy, we had materials, we had financials, industrials, and technology and consumer discretionary did not perform well during this period. And as a result, you can see the growth versus value ratio dropping. But notice what's happening in June with interest rates dropping. Money is going right back into those growth stocks. So now that inflation, and this is my read on what's taking place, my read is that the market is not fearing inflation. There's headline news, probably going to see some more headline news over the next month or two, and then I think things will die down. I think by the time the summer wears on and we start to head for the fourth quarter, if the growth stocks aren't already leading in a major way, I think they're going to be in the fourth quarter. But anyway, it looks like maybe we've gotten off to a pretty good start here. We did get to that 170 level. Let me just annotate this real quick for you, because I think this is a level that you really want to watch. Here, we topped at 170, went down, broke out. Notice we had a double bottom at 170 before breaking down. This is simply the ratio between the IWF, IWD. The IWF is a fairly concentrated, ETF that invests in many of the large cap tech stocks, Microsoft, Apple, and those names. The IWD is a much more diversified list of value companies. I think, Berkshire's in there and some others. I don't know, Berkshire might be the #1 holding, but it's much smaller. So it's a very widely diversified value ETF. You can see that the Apples and the Googles and the Microsofts, Amazons, they're all starting to pick back up again. And that's what's driving this ratio higher. And those are the poster children of growth stocks. Those are the large cap growth. And so what the market is saying is that money is rotating back into those areas. And can we get through this 170? Is this going to be a double top and back down again? Is this a head fake? Anything's possible. But based on everything else I'm seeing right now, I don't think that we're going to go back down below 155. I'd be shocked. I just don't see it based on the dollar rebounding, based on gold tumbling. That just tells me that inflation play is dead. Maybe it gets revived, but right now I would say that is not the direction I would want to go with my portfolio. All right, let's keep moving on here. So the dollar. Now, this is a long-term, this is a daily chart, but I just wanted to kind of show you because there's the move right there on the daily that we've seen recently in the dollar, just in the past, really just the last week or so, especially since the Fed meeting last Wednesday afternoon. But I believe the dollar is moved up, continued. This is the dollar index. I think holding this low right here at 88 was crucial. And now it's moving back up through its moving averages. As it turns back up, look at materials. Look at the drop materials made on a relative basis versus the S&P 500 last week. Now, it did that back at the beginning of the year and then rallied back. So I don't think we can write it off. But again, this is the dollar moving up is kind of what I was calling for from a longer term perspective. And if I'm right and that dollar keeps moving up, especially if it gets through about 93.5, then I think materials, probably this entire run is over. Doesn't mean we'll go to a new low. Maybe we just go sideways for a while. I mean, I could see something like this, or I could maybe see just a slight downtrend, maybe something like this that we saw in the second half 2019. I don't know, but it just seems to me like we needed to get back through this high right here, and we didn't do it. A downtrend consists of lower lows and lower highs. Here was the low. Here was the ultimate reaction high, double bottom, triple bottom maybe. And then this was the new low, which took out this low. That means this high is really important. We didn't get there. We got almost to it and then rolled back over. So I think from a long-term perspective, you've got to be very careful with materials right now. All right, I wanted to pull up the relative strength of industry groups just to show you the last month. This is our industry group relative strength chart list that we keep at Earnings Beats. Any of our annual members can download this from our website. It's 104 charts. Once you have this into your stock charts account, this is, you have it forever unless the industry groups change. But it's pretty cool because it just gives you over different time frames a very quick reference as to what's leading. Look at the last month and look at what's in number 3, 4, 5, 6, and 7. Semiconductors, software, internet stocks, automobiles, renewable energy. 5 very strong growth areas of the market. And those 5 are in the top 7 right now in relative performance over the last month. That's through all of this inflation. Inflation eats away at the value of growth companies. That future growth of growth companies, that's what drives valuations. Inflation eats into it. So if inflation was a problem, do you think these 5 areas of the market would be right now in the top 7 over the last month? And then you go down the list, financial administration, then you've got broadline retail, specialty finance. These are all areas that should do well in a more growth-oriented market. So let's see what happens, whether or not we get that breakout on the IWF, IWD above that 170 level. All right, earnings spotlight. Not Not really a whole lot. We start to see some more companies coming out later this week. Tomorrow, Plug Power will be releasing its earnings. It was going down for a while, but it started to move back up heading into earnings. We'll see what happens. I expect we'll have decent earnings. More important, though, will be the reaction. Can we take out this high, or do we start to move back down toward this low? My guess is we're going to probably make a move back toward the high, but it's a guess. Thursday will be the big week for earnings. We have Nike, Accenture, FedEx, one of our portfolio stocks, Darden Restaurants, BlackBerry, those names. And then on Friday, Paychex, CarMax, and another solar company, Jinko Solar, JKS. So got more coming out later in the week, but earnings will pick up a little bit as we go toward the end of the week. All right, let's do our 3 you must see. I'm going to start with Smith & Wesson. Look at the breakout on Friday. We had a top here in September, another top in January, another top in June, all around 22, 22 and a half. Friday, we actually broke out above 23 on very heavy volume, making a breakout. That's worth noting. Next stock, Roku. Pulling back a little bit, market just opened. Pulling back a little bit today, but I actually think this is one that if growth, we see that IWF breakout, don't fall asleep at the wheel on Roku. Roku can move very quickly. And what I'm going to be interested in is if we pull back, do we hold that 20-day and start to turn back up again? If so, that'd be a bullish sign for Roku. Last one I wanted to mention was PAGS. This is PagSeguro Digital. I just wanted to point out, when you see a stock that's trending lower, lower lows, lower highs, lower lows, and then you see it start moving up, taking out these highs, pulling back, holding the 20-day, and then breaking out again. This is the kind of pattern that I'd be looking for with these stocks that are downtrending. And then all of a sudden they break and they start holding that rising 20-day. That's the sign of an uptrend. If you lose the 20-day, it's more sideways consolidation. But when you're holding that 20-day and the 20-day is rising, the 50-day is rising, and price is rising above all that, that's usually a really good sign. So I just wanted to point out some of the things you might look for in some of these companies when they start to reverse back to the upside. All right, let's go back to the homepage. Let's see what's going on in the market. The Dow up 176, S&P up 12, NASDAQ down 23. So now we're getting another reversal. I'll tell you, this year, for me anyway, has been very difficult. Long-term, big picture, I think the call has been pretty clear. I've been bullish, market's going up. But the rotation within the market has made it so difficult this year because you just can't trust a move before. Last week, the NASDAQ, the growth stock's doing really well. You wake up Monday morning, the Dow's got futures up and then the NASDAQ's down. And we've been seeing a little bit more of this. I do like other areas. And as I mentioned earlier, I think everything is pointing to money returning back into growth. And I think it's already started. But this is anything but easy in the near term. So if you've been struggling in the market, you're not alone. You can trust me on this one. There are a lot of folks struggling because of all the rotation in the market. Just when you get comfortable with an area like financials, the carpet gets pulled out and you get that initial reaction from the Fed. Yields went up to about 160 or close to 1.60. And then 2 days later, it's right back to 1.45. I'd written an article about the fact the financials were doing really well out of the gate, leading after the Fed meeting. And then they fell flat on their face, 2 days later. So this is a difficult market. I do think long-term growth stocks win. That's my opinion. Short-term, just get ready for a lot of whipsaw. I think, that's probably what we're going to be looking at. So maybe we get a little bit of a bounce here at the beginning of the week because a lot of these companies in the Dow and S&P materials and so forth, a lot of these companies got hit big last week to the downside. Maybe we're going to see some of that rally here at the beginning of the week. We'll see. Anyhow, that's it for me. I want to thank everybody for tuning in. Appreciate all of you. And I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. That will, of course, be my recorded version. I do think Stock Chart's going to be opening back up fairly soon. Hopefully have some news for you over the next few weeks. But I hope within, maybe by the fourth quarter, maybe we'll have some live shows again over at Stock Charts. Anyhow, everybody have a great day and be back tomorrow. Happy trading.